Good afternoon, ladies and gentlemen, and it's great having you with us, and it's a great honor being with you. I would like to thank The Economist for its kind invitation to moderate especially this interesting panel. I'm John Papageorgiou, and it seems that the bicentennial of the Greek Revolution, or the 200 years of Greece's economic survival, finds us in a post-bailout era. The debt, but not only debt, crisis finds Greece in the framework of the enhanced surveillance program, the EU enhanced surveillance framework, and under the post-program monitoring according to the IMF framework. Our distinguished speakers were involved in all recent Greek bailout programs, and it's a great opportunity to listen to them and see at which level these programs worked, how effective they were, what lessons are learned or should be learned in order to avoid such crises in the short but in the long-term future as well. It's an honor having with us Mr. Poul Thomsen, the former director of the European Department at the IMF, Mr. Thomas Wieser, the former president of the Euro Working Group. Gentlemen, thank you for being with us. And of course, there is a lot of talk, and allow me to say a lot of speculation about the 2009-2019 decade. So before any questions, before my questions or the questions we may have online, I would like you to share with us, first of all, where we stand, your conclusions after these programs, and if possible, any highlights from your personal involvement. Mr. Thomsen.
Thank you very much, and thanks for the invitation, and hello to everybody. Hello, Thomas. So I think this is a very timely debate. What can we learn from how we dealt with the Greek crisis? Because I personally think that we are at the risk of repeating some of the mistakes that we did back in dealing with the Greek crisis. And let me say in this regard, I certainly look at the situation quite different from I did in 2010. Let me make four brief points, four brief succinct points. The first one is that I am quite pessimistic about Greece's ability to prosper within the Eurozone. I'm here looking at 10, 20 years. What happened beyond that, I don't know. And my views are very much rooted in what we have heard today, the clientelism of the system, and Mr. Papandreou just brought it out very clearly. The decision to admit Greece to the euro was clearly a political one that had no basis in economic realities. It was based on this notion that if you put a country in a straitjacket, politicians would be forced to adopt the necessary reforms. That has proven naive. It has not happened. It didn't happen before the crisis, has not happened since. Greece was forced in 2012 by the Europeans and the IMF to adopt some pretty important labor market reforms, and in 2015 to some pension and tax reforms that would have made the fiscal policy much more growth-friendly. But these reforms were either not implemented or later reversed. So you might say that the current government is doing things. Yes, I know it's sort of picking up on privatization, some digitalization, but this is really tinkering on the margins compared to what really needs to be done in a world where everybody else is doing a structural reform. I don't see Greece closing gaps. I see it will struggle to prevent that its young people will continue to leave Greece in large numbers to seek a better life abroad, all because of the clientelism that we have discussed this morning. This leads me to my second point. The 2010 program was clearly much too optimistic in its assumptions about economic growth because of my first point. This meant also we were far too optimistic about Greece's debt servicing capacity. This does not mean, I would stress, that we should have insisted on a debt restructuring in May 2010. I still think, given the lack of a firewall, crisis resolution mechanism, we had no other choice than bailing out creditors at the time. But I think we, certainly the IMF at that time, with the benefit of hindsight, should have insisted with the Europeans, with Germany, that once these firewalls are in place, there will be a debt structuring. We didn't do that, and what really happened with the bailout of creditors ended up in what should have been a fairly straightforward technical issue of debt restructuring, ended up becoming hopelessly politicized by being sort of this north-south focal point with all the sensitivities about transfer union. And I think that was, in retrospect, a serious mistake. My third point is on debt sustainability analysis. They are not only wrong, they are also irrelevant. And here I'm talking both about what the IMF is doing and what European institutions are doing. European institutions attempt to justify the high debt by providing debt sustainability analysis that goes off far into the future and shows that over the very, 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 very long run, at some day in the future, debt can become sustainable. They are based on growth assumptions that are not consistent with the political realities regarding reforms. But more important, of course, any solvency problem can be shown to be a liquidity problem if you allow projection period for several decades or many decades. That's not credible. That's not a credible projections, and creditors would, of course, not consider it credible. They would know that the country will be a sitting duck for decades, waiting for the next, while debt is slowly going down, waiting for the next crisis to blow it off course. But in the euro area, creditors has been willing to accept it. Why? Because they know they will be bailed out. It's and this brings me to the what I think is the overarching conclusion from the euro crisis. The euro crisis has not created any meaningful progress towards a political union, and certainly not as far as reforms and fiscal is concerned. One can argue with the SSM and the financial sector there have been some progress. But on fiscal policy and reforms, the things that matter for real convergence, we are not anywhere closer to a political union. But what the euro crisis did, true to the bailouts, the Troika bailouts, and in particular the ECB's promise to do whatever it takes, it means that creditors are just not interested in debt levels as long as they can be persuaded that they will be bailed out. I have gone to endless investor conferences in Greece, in Italy, and others where investors are not really interested in the local policies, but in whether Europe is going to bail out whatever happens. So I think all these debt sustainability analyses are largely irrelevant, and we certainly in the IMF failed to understand that by providing debt sustainability analysis that did not take into account that this is a currency union where other countries are supportive, but the Europeans, on the other hand, sort of have these projections that shows that one day we will get there over the very, very long run. The critical issue here is, of course, that while we have these bailouts, we have nothing to ensure that the countries use these bailouts as a breathing space to do the right thing. And we have a moral hazard problem. And let me give you one observation, which is actually quite spectacular if you think about it. All Europe's high debt countries entered the COVID crisis with debt levels at or above the already elevated levels with which they had exited the euro crisis. Despite the fact that they had a huge increase in debt, they did nothing to bring it down in the anticipation that they would be bailed out. And they were right. They were bailed out. I'm not saying one should not have done what one did recently under the COVID crisis. There's a strong humanitarian case for that, but we should not fool ourselves. It is a bailout. It's a bailout in a situation where Europe does not have a mechanism for ensuring that the countries do the right thing, and we should certainly expect the need for more bailouts down the road. My fourth and last point is very related to this. This COVID crisis will, despite the mutualization and grants coming from the European Recovery Fund, entail a huge increase in indebtedness of countries and increased debt levels of the already indebted countries to very, very high level. There will be pressures for more austerity down the road. There are significant pressures for austerity. Of course, this is politically unsustainable, and of course there will be strong tensions, north-south tensions, and pressures for debt restructuring and bailouts. This time around, it's not happening through the ESM, which is too small, but through the European Central Bank, which means that I cannot see how the European Central Bank can avoid to be severely politicized in the future, the way we are handling this crisis. I, of course, understand why here in the midst of the crisis, policymakers would not want to insist on a debt restructuring of the highly indebted countries. But let's not fool ourselves. Once we are over the crisis, there will be a need for this debt to be written off. And of course, we're already seeing pressures from Italy for the ECB to write off the papers that it's buying under its asset purchase program. One way or the other, there will be a need for debt restructuring, and they will be very noisy, very political. But this COVID crisis will dramatically increase north-south tensions down the road. I'll stop here.
But first, I will have to pass the floor to Mr. Thomas Wieser, the former president of the Euro Working Group. And Mr. Wieser, already Poul Thomsen has set an agenda. But first of all, I would like to have your approach.
So, thanks very much. Thanks for the invitation. Greetings to Athens and wherever Paul is sitting, and others. And I just was able to catch former Prime Minister Papandreou's contribution today, and I think very, very much of what I would have initially said was said by him about clientelism, etc., etc. And I still distinctly remember the day when George Papakonstantinou entered the Eurogroup meeting room and essentially said, Brussels, we've got a problem. And the conclusions that other finance ministers drew were that the main problem, or the only problem, was fiscal. And of course, the more that we delved into the underlying issues, the clearer it became to me and quite a number of others that the fiscal side was merely a surface phenomenon of totally different and very severe underlying imbalances and problems. But as I said, the situation led very many actors to believe that the only problem was fiscal. And this had consequences for the programs and also for policy developments at the European level. And even though many of us realized it at the time, I think by now very many are cognizant of the fact that we in Europe collectively, more or less collectively, stumbled into the situation lacking understanding and instruments and the political ability to solve the situation. That also, again, reflected on the design of the first program. And these instruments and understandings and politics, they evolved over time, but not very rapidly. And that, in a way, also led to the fact that the IMF was involved and how the IMF was involved. And there was quite a discussion at the time amongst European politicians on whether the fund should be in or the fund should be out. And interestingly enough, I remember at one occasion Wolfgang Schäuble saying to Jens Weidmann, who at the time was the economic policy advisor of Angela Merkel, Wolfgang Schäuble turned to Jens Weidmann and said, well, if you honestly remember how the discussion went at the time, you will recall how very much against the involvement of the IMF I was, and how much I, Wolfgang Schäuble, was insisting that we in Europe had to deal with this issue all by ourselves. But you, Jens, Mr. Weidmann, I think he called him, you successfully persuaded the Chancellor that the fund should be involved. At the same time, over there in Washington, the managing director, the then managing director of the fund, and quite a number of staff were all gung-ho to be involved in these issues because it came upon a period, an era, where the fund was laying off people en masse, thinking many outside commentators and member states reflecting that in the Goldilocks economy of the times, the fund as such in this structure, etc., was not necessary any longer. So, as we know, there was hardly anybody in Europe who knew how to put together such an adjustment program. And we've seen a couple of reasons why the issue of debt sustainability was not solved in a more decisive manner and more upfront. And if I think what was the largest mistake we made in between 29 and 2018, it is the debt sustainability issue. As others have said before me, the times for a haircut in 2010 were absolutely not appropriate, but one could have dealt with it in a different manner. But what we need to remember is the whole setting up of the euro area was built on the totally mistaken understanding that there could be no current account crisis, hardly any meaningful imbalances between member states, because money was fungible, we had one central bank, and as such, entering EMU, the euro area, the European Union, had done away with the so-called balance of payment mechanism, which is which was and is a fund to fund such adjustment programs. Given the enormity of the Greek problem, it would have been pitifully too weak. But again, I want to emphasize there was a complete lack of understanding of what the issues were. And not only amongst prime ministers and finance ministers, but well down into many chancelleries and finance ministries and even central banks. Given this lack of understanding, there was also a total lack of instruments. And if you don't understand what the issue is, then you don't start building an instrument to solve the problem that you don't understand. We collectively, Europe collectively learned the hard way, and we do now have the European Stability Mechanism. We have, since people painfully were made aware of the doom loops between sovereigns and banks and sovereigns, we partially solved the problem by setting up the single supervisory mechanism and a couple of other issues. But were we able did we want to, and were we able to solve the huge structural underlying issues that not only the Greek economy but the Greek society was facing? And I'm not as pessimistic as Paul. We have to keep our respective attitudes there. But I would say there were attempts, significant attempts in the program to solve these distributional issues. And I think as soon as one does a post-mortem on a program, I remember the post-mortems on IMF programs in Asia, and says, "Oh my God, we've made this huge mistake. We were much too invasive. We were much granular. We should have tried to define what should the outcome be and not prescribe minutely the liberalization of taxi services and pharmaceutical issues and shipping industry between Athens and Crete and Athens and Samos and hundreds and hundreds of pages of actions. But as soon as you're confronted with the reality on the ground, bingo, there you go. You attempt to liberalize pharmacies, taxis, this, that, and the other, not by saying to the Greek government, you will get an adjustment loan if you liberalize your economy and get rid of clientelism. For some reason, it never works that way. And again, I was approached by Greek friends who said, "Oh, the program is not intrusive enough. You have to change our educational system. You've got to change our justice system. You've got to make sure that the police can enter universities again. You have to make sure that this doesn't happen, this happens, and this doesn't happen." I say, guys, we're already under fire because we're much too invasive and intrusive into the Greek economy and the Greek society. This is an issue that ultimately, in the interest of sovereign self-respect and in the interest of the representativeness of democratic institutions and elections, the Greek society has to want and implement. And if you don't, you don't. But don't want us, the institutions, and the other member states to be so invasive that the last vestiges of government disappear. It can't work. So this, in a way, encapsulates for me the huge dilemma that one faces with all programs and with programs within the euro area very specifically. Maybe a couple of conclusions there. One, the role of the European institutions. A bunch of geniuses in 1944 set up the Bretton Woods institutions and created the IMF as an institution which had more or less one mission in life. It was financed, with one or two exceptions, with central bank money, which is not under the purview of national parliaments. It is the nasty bogeyman sitting in Washington, and you can be totally pissed off with the IMF and get on with your other business. The European Commission, on the other hand, is an institution which is the central European institution in dealing with member states. And out of the 189 issues that the Commission has on its plate with a certain member state, for 188, it needs an amicable, not antagonistic way of collaboration. Then you expect the Commission to behave as the IMF does, as being intrusive and ordering a member state to do something. It doesn't work. So asking the Commission to do anything similar to the IMF was a failure right from the beginning, and I'm not quite sure if the ESM, as it is set up under finance ministries and financed by government, is yet fully fit to take over this role. Secondly, within a monetary union, you give up a huge amount of sovereignty, and it is well known to prime ministers, finance ministers, and others that you give up monetary autonomy. But few people want to realize how much on fiscal sovereignty and other sovereignty you give up. That is a dilemma. How do we run fiscal policy, which on the one hand is under the purview of national sovereign parliaments, but on the other hand is geared in such a manner that it does not create imbalances and instability for the other members of the euro area. And lots of people writing about it should stop dreaming about a fiscal union, common fiscal policy in our lifetime, no matter how young we are. You, of the three of us on the screen, are the youngest, John, but even you will not live to see a fully functional fiscal union. So, as Mario Draghi used to say, either you've got institutions, ECB, or you've got rules. But how do you structure the rules that they're intelligent, that are kept to, and are that respect, by and large, both the issue of sovereignty, but solidarity, and treating policies as matters of common concern within a monetary union. It is very difficult, and I think we're still quite away from there. I will, no doubt, you will be picking up, John, on Paul's issues about future debt restructuring and the like. So I will refrain from commenting on them. I will just close for now by saying that in mid of 2014, I was pretty confident that Greece could be, in a way, on track to having debt relief and exiting the second program in a fairly decent manner. So, for those who think that it was only from 2015 onwards that problems emerged, no. The second half of 2014 made one already extremely pessimistic and showed that the problems were multi-party problems, Greek problems, and not confined to only one government. But in 2015, of course, we came extremely close for the Euro area, all of a sudden being made up only of 18 and not only 19 member states. And much of the trouble and grief that Greece went through over the past 5, 6 years can be attributed to happenings in the first half of 2015. So I'll stop for now. I think Paul and I could go on for 7 hours in reminiscing and reflecting on what happened, why and why not. But we've got time constraints here as well. Thanks very much.
Thank you for this, Mr. Wieser. I will come back to the euro area upcoming framework. Let's call it like that. But let me, for a bit, stick on the reform agenda. In my opinion, and I do not think that I am an exception. When we say reforms, we mean development, we mean change, we mean progress. But that was not the case in Greece. In Ireland, for example, that was pretty much different. So there was, and at some point there still is a misunderstanding or a lack of ownership. So first of all, the question is why? And second, and most important, which package of reforms hasn't been implemented and could be a game changer? Mr. Thomsen?
Yeah, so I think there is no sort of silver bullet as far as reforms are concerned. One single reforms. It's really a broad modernization of the economy. It is after some important labor market reforms, and here I want to say that I fully agree with former Prime Minister Papandreou that they tried. And they want to stand up to their own political base by doing difficult labor market reforms. New Democracy never stood up to its base by opening up the economy, closed professions, and as a result, PASOK, of course, paid a terrible price. So I think one need to give Papandreou and his colleagues, Papa Constantino and others, credit for that. The reforms did not happen because of the clientelism that we talked about, which you don't see in Ireland. In places like Ireland, they basically told us what they wanted to do, and they did it. The key issue, I think, inside the public sector is pension reforms. Pension systems are totally unaffordable, and tax reforms. Essentially, Greece gives a sort of Northern European type pensions with a Southern European type tax system where it doesn't tax the middle class. It's fundamentally unsustainable. The result is it has to compress all other expenditures now to levels where the state cannot deliver basic public services and compress capital spending, which is bad for economic growth as well. But the problem is rooted in that this clientelism, and I fully what we learned from the Troika, but which the IMF have learned, long before that, is that you cannot impose these reforms. You cannot impose such structural reforms on its system that it sticks. And this is, of course, comes back to what Thomas said and what I said before. Europe has not developed the means for forcing Greece to do it, because it's politically just not possible. This would require a transfer of sovereignty that will not happen in our lifetime. But let me also say then, when I hear, for instance, Papandreou say we should pool our risks because we are stronger together, it's no northern politician in his right mind should accept to pool the risk in a country, as we have discussed, that has 200 years of clientelism. So that is the dilemma. It is the dilemma that Europe need to provide the support, but Europe has no meaningful way for ensuring that Greece do the right reforms, and that's why I am fundamentally pessimistic about the outlook.
Mr. Wieser, on the reform agenda, and I will come back on the EU and the debt later.
Well, as more or less as Paul, we had 5 adjustment programs for Greece, Ireland, Portugal, Spain, and Cyprus. And if we have a sort of spectrum where countries say this was largely my fault, and where countries say this was largely foreigners' fault, Ireland is the country with the greatest degree of critical introspection. They said, we did things wrong, we'll do them right, we'll change, and there we go. And Greece is the country most prone to saying it was the foreigners. And therefore, let's not change too much. And I think that colors very much this question on ownership, for example. And ultimately, if you think of where one would really want to be, where one would love to see Greece, I would just, if needed to be short, I would say, as soon as it is a meritocratic society where you have equal access to hospital services, no matter where you don't need an envelope, where access to concessions is equal, where a country where you don't have, let's say, ownership structures of industry or shipping and media, which in most other countries would be subject to severe limitations because they push special interest groups and the like, i.e., get away from nepotism and towards meritocracy. And if you pursue this principle, this deals very much with the quality of public administration, which for me, which started out many, many years ago, not so bad, but then for a variety of reasons went down the hill. It would solve issues with how you define pension rights, access to social policy payments, etc. So it does away with favoritism, and if it does away with favoritism, many issues that also Paul mentioned would not be as severe as they may be. Let me say already now that I don't see the future as bleak as Paul does, but voilà, à discuter.
Looking forward, Mr. Thomsen, you told us in the beginning that the presence of Greece in the euro area back in 2010 was a problem in order to face the fiscal and the debt crisis, back then the fiscal problems and the debt crisis. Some years later, now, there is a new EU framework. Common debt is going to be issued through the Recovery and Resilience Facility, through the Recovery Fund. And actually, the landscape is a bit different. The Greek debt is, let's say, in the family, in the euro area. So the question is what Greece has to do in the short term, and which questions have to be answered within the euro area in order to create a new fiscal or financial framework when the pandemic is over, when the general escape clause is removed. Paul?
Well, yeah, I mean, as I said, despite the grants, despite the debt neutralization that's now in the new pandemic recovery program, debt levels will go up dramatically, right? France and Italy will have debt that will get up significantly above where they are now. Italy will be up close to Greece's, and Greece will be off the charts when it's all over. Now, how much depend on a number? There's some uncertainty, but it will go up dramatically. That will entail pressures for austerity. That you're not going to get the Europeans to say, we're going to continue to bail out and provide future bailouts. They will want to sort of get an understanding that debt comes down through austerity. We know that will not happen, and we know that, but the pressures will be there, political tensions will be there. And of course, it will not come down significantly. And when the next crisis comes, Europe will have to bail out again. The fundamental dilemma is, as I said, the moral hazard one, that in such a system, there's really no incentives for Greece and other countries to deal with their problems. And that's why the Eurozone is fundamentally, dynamically unstable in the absence of a credible move towards political union, where essentially Brussels tells the Greeks when to retire. That's politically not going to happen. I agree with Thomas at that. I think the major issue now is we are no longer bailing out through the ESM. It is the ECB that is bailing out. And now the ECB is deviating from its key, or stand ready to deviate from its key, and creditors are very happy with that. And actually the ECB doesn't have to deviate much, because as long as it's promised to do so, creditors are very, very happy. But once we get to the point, and I personally think it comes faster than most people think, but that's a personal view. Once we get to the point where ECB will start tightening, this north-south fragmentation will come back with a vengeance, because there will be a time where cyclical conditions in the north suggest that there should be a tightening, and at that time there will be major problem in southern countries once that tightening comes. When that's going to happen, I don't know. 1 year, 2 years, 3 years, I don't know. But it's going to come. And at that time, there's clearly a big risk that the tightening will be delayed, fiscal dominance, ECB will be further politicized. Now, southern countries have already put former ministers of finance at the EC board and ECB management. So this will become a significant political issue down the road. The tightening will probably come too late. Inflation will go up, but at one stage it will have to come. And at that time, you get dramatic north-south tensions and pressure for debt reduction. So that's why I say I think the COVID crisis will, because Europe has not moved meaningful to a political union. On the contrary, instead of catalyze movement toward a political union, the bailouts and the whatever it takes have actually undermined the compliance with the feeble rules that were put in place as a substitute for political union. And Europe doesn't have an answer to that. And it will come back to bite Europe over the coming years.
Mr. Wieser, your approach, what do we have to do within the EU? First of all, in order to answer the right questions, and then to avoid what Poul Thomsen just said.
Let me just remind Paul that one of the two finance ministers of the ECB is the former managing director of the IMF. So I would argue that not only she, very much so, but not only she is well qualified for that role. Look, I mean, the fundamental dilemma, as we all realize, is that if you call for solidarity within a monetary union, be it either through monetary policy or through fiscal policy or whatever, it's a two-way street. And you can not only request others to come to your help, you also must give up a certain amount of sovereignty over your policies. That is exactly what Paul meant when he said, when he talked about the role of Brussels in a political union. But of course, such a change is not something where you jump from no coordination to full political union. And I still strongly believe that we have to move step by step by step along that continuum and need to have not only a rules-based system that produces better policy outcomes, but some kind of political mechanism which increases the costs of non-compliance. And we've tried quite a number of things over the past nearly 25 years. The Stability and Growth Pact had nuclear fines at the end of a very large, long, lengthy, and complex series of administrative and political steps. It never worked because it was just too unbelievably nuclear. For a time, there was a belief that the no bailout clause was a valid one. And as long as people believed that, there was also a certain strength or a harness around national policy making. So we need to devise some kind of methodology how political costs for prime ministers, how political costs for finance ministers are significantly increased if they run bad policies. That can be accountability to appear before the European Parliament, naming and shaming. There are many different variants, none of them 100% satisfactory. But what is clear to me, and is clear obviously to Paul as well, the belief in the no bailout clause of the treaty has been shattered, and there is no way of going back to that. And the sooner we come to admit that in politics, economics, and also legally speaking, the better it is. Let's I offer you one thought experiment. How is it in the United States with the state of, let's pick Mississippi, which runs a sometimes astonishingly separate, as many others do, environmental policy, social policy, etc., etc. It works in the US, but there are two consequences, or three consequences. One, there is a higher degree of reliance on federal funds and the federal tax policy. Secondly, the talented people get on the Greyhound and they move to Georgia, Massachusetts, and God knows what. And thirdly, there is an acceptance in the United States of very, very different levels of income per capita and poverty, which is why Mississippi is where it is in the ranking of US states. And that is also a possibility for Europe, but it is not a way I would want Europe to go. So, for the medium term, which is over the next 10, 15 years, we've got to realize there would be no significant pooling of sovereignty. I don't think there will be a bailout. I share the concerns of Paul. What happens when there's mean reversal in monetary policy? But for now, things are quiet, and financial markets change their tone every 6 months. And contacts tell me, oh, there's absolutely no concern at all. Hardly any spreads, interest rates are low, and we know that these things don't stay as they are for eternity, but can turn around pretty fast. So that I'm sure that the Greek political system has it in it, if it is willing to have a national debate on what the problems are. If it is willing to have such a national debate, I believe there is a willingness to change. But indeed, Prime Minister Papandreou was punished for trying to have that debate. And as peculiar as it sounds, I think some of the ministers around Alexis Tsipras were also cognizant of many of the problems that Greece was facing, but they fell into the same traps as the previous government.
Thank you, Mr. Wieser. We are running out of time. We have run out of time. I have to ask a dozen of questions. I would like to ask a dozen of questions. Regarding the online questions, all of them have been answered. All of them were more or less what we should have done differently, like Mr. Chrysantho asked. So my hope is to meet you both in Athens after this mess we're living in is over, in the post-pandemic era. And I would like to thank you both, gentlemen, Mr. Thomsen, Mr. Wieser.
It's a pleasure.
Thanks very much.
Thank you.
Thank you.
Pleasure.
Both of you.
Bye.
I look forward to meeting both of you, wherever it may be. Thanks very
You owe
much.
me a beer.
Have a nice evening.
I owe you a couple of beers, Paul.
Thank you. Bye-bye.
Good.
Bye-bye now.
Bye-bye.